Elon Musk is worth over $200 billion. You'd think a guy with that kind of money just pays for stuff, swipes a card, buys a private island, done. He doesn't. He borrows it, on purpose, constantly. So does Jeff Bezos, so does Larry Ellison, who owns an actual Hawaiian island and somehow still qualifies for financial moves that would make your bank call you personally. There's a name for this in finance circles. Economists call it buy, borrow, die. Sounds like a heist movie plot, and honestly, it kinda is one, except the guy getting robbed is the US Treasury, and it's completely legal. Here's how billionaires manage to live like royalty, pay next to nothing in taxes, and never technically sell a single share.
Okay, quick reality check. When you get a paycheck, that's earned income. The government taxes it immediately, before you even see it. But billionaires don't really have income in the way you do. Their wealth isn't sitting in a checking account. It's tied up in stock, shares of the company they founded or invested in, sitting there quietly multiplying in value. And here's the part that breaks people's brains. Unrealized gains are not taxed. Meaning, if your stock goes up in value, but you don't sell it, the IRS legally cannot touch it. On paper, you're a billionaire. In terms of taxable income, you might report less than your dentist. So the question becomes, how does a guy with $200 billion in stock actually live? Buy homes, buy yachts, buy a social media platform on a whim? He doesn't sell the stock. He borrows against it.
This strategy even has a name in finance circles. Economists call it buy, borrow, die. Sounds like a heist movie. It kind of is one, except the victim is the US Treasury. Here's how it works, step by step. Step 1, buy. You acquire assets that appreciate. Stock, real estate, a business. You don't touch them. You let them sit there and grow in value, tax-free, because again, unrealized gains aren't taxed. Step 2, borrow. Instead of selling your stock to get cash, which would trigger capital gains tax, you take out a loan and use your stock as collateral. Banks are thrilled to do this because lending against a guaranteed asset is about as safe as lending gets. These loans even have a name, SBLOCs, Securities-Backed Lines of Credit. Rich people basically treat their stock portfolio like a permanent ATM. And here's the kicker, loans are not income. So this borrowed cash, not taxed at all. You can literally borrow tens of millions of dollars, buy a mansion, buy a yacht, buy a football team apparently, and the IRS has nothing to say about it because technically you didn't make any money, you just borrowed some. Step 3, die. This is the part that makes tax lawyers grin and everyone else furious. When you die, your assets pass to your heirs under something called the step-up in basis. Basically, the cost of the stock resets to its value on the day you died, erasing decades of gains for tax purposes. Your heirs can then sell the stock, pay off whatever loans you took out, and pocket the rest, often paying little to zero capital gains tax on wealth that grew for 40 years. Grow the wealth tax-free, live off borrowed money tax-free, die and let the kids inherit it, also mostly tax-free. Meanwhile, the average paycheck gets taxed before the coffee it paid for even finishes brewing. Somehow, this is the system we all agreed was fair. Let's make this less theoretical. Elon Musk has famously reported near zero income in certain years, despite his net worth swinging by tens of billions. How? Instead of cashing out Tesla stock, he's borrowed billions against his shares to fund lifestyle spending and even the X acquisition. Larry Ellison, co-founder of Oracle, has had lines of credit exceeding $10 billion, all backed by Oracle stock, which is how a guy buys an entire Hawaiian island the way normal people buy a used car. Even Jeff Bezos, for years, reported income low enough that he technically qualified for a tax credit designed for low-income families. The founder of Amazon, on paper, occasionally poor. The paperwork did not reflect the yacht. This isn't some rare secret loophole 3 guys found. It's a known, structural, completely legal strategy used across the ultra-wealthy. ProPublica actually got leaked IRS data a few years back and confirmed this pattern across dozens of the richest Americans, some paying an effective tax rate of under 1% relative to their wealth growth. 1%! Sales tax on a bag of chips is higher than that. Here's why this isn't reckless. It's actually a genius use of math most people never get taught. Interest rates on these loans are often lower than capital gains tax rates, so even paying interest on a loan is cheaper than paying tax on a stock sale. You're literally choosing the cheaper bill. Their collateral keeps growing. While they're living off borrowed cash, their stock, the thing backing the loan, is often still appreciating, so functionally, their wealth is growing faster than the debt they're racking up. Banks compete for this business. Private banks roll out the red carpet for billionaires wanting these credit lines because it's basically risk-free lending for them. It's not some sketchy backroom deal. It's a whole industry built specifically to serve this strategy. This is the actual difference between being rich and money smart on paper rich. It's not about how much you earn. It's about how you're taxed on what you already have. Now, here's where it gets interesting, because technically, you can do a mini version of this. If you own a home with equity, a HELOC, home equity line of credit, works on a similar basic principle, borrowing against an asset instead of selling it. If you have a solid stock portfolio, some brokerages offer securities-backed loans to regular investors too, not just billionaires. But here's the catch nobody tells you. This strategy only works if your assets are growing faster than your interest payments. For a billionaire with a diversified, appreciating empire, that's basically guaranteed. For an average person, interest rates, market downturns, and forced loan calls can wreck you fast. Borrowing against volatile assets without billionaire-level cash cushions is how regular people go from clever to financially ruined in one bad market year. So no, this isn't a hack your way to rich tutorial. This is a understand how the system is built so you stop blaming yourself for not being rich video.
Here's the uncomfortable truth this whole strategy exposes. The US tax system taxes labor far more aggressively than it taxes capital. If you work for your money, you get taxed immediately, automatically. No way around it. If your money works for you through stocks, real estate, ownership, you get to choose when, if, and how you get taxed, with entirely legal tools built to delay it, minimize it, or avoid it altogether across generations. That's not a conspiracy theory. That's literally how the tax code is written. Several proposals, like taxing unrealized gains for ultra-high net worth individuals, have been floated in Congress over the years specifically to close this loop. None have passed, because, shockingly, the people with the money to lobby against it have the money to lobby against it. So, next time someone says, just work hard and save, remember, the wealthiest people in the country aren't playing that game. They're not selling anything, they're not earning income in any way the IRS recognizes. They're just quietly borrowing against a pile of money that keeps growing and handing the tax bill to absolutely nobody. Not a conspiracy, just really, really good paperwork.